Iron trades.
Okay, so today we are going to be reviewing Fibonacci. What is Fibonacci? How is it useful? And how do we implement it in trading? First, general housekeeping. Nothing in this coaching or education constitutes financial advice. All materials are intended for educational purposes and to enhance technical ability. Lessons will be recorded for posterity, and coaching is a self-driven educational partnership, so no specific trading results are guaranteed as an outcome of any of this education. Always like to put this first. I encourage everyone to familiarize yourself with candlestick patterns. You do not need to know all of them, and this is by no means all of them, but picking some that you become most acquainted with is the best way to improve your edge, update your strategy. I recommend some of the more common ones, such as the falling three and the rising three. You see them very commonly. 3 stars to the south and in the advanced block very commonly. Those also play out really well on things like primed RSI. The morning star, evening star, just another version of the hammers and the dragonfly, or the shooting star and the gravestone. And then bearish engulfing, bullish engulfing, both very worthwhile. So, what is Fibonacci? And where does it all come from? Fibonacci is a simple number sequence. Each number is the sum of the two numbers that came before it. And you've probably seen it before, whether it's the spiral pattern that you can see on your screen or it's the general number pattern that you can see laid out in the text. You can see that if it starts at 0, the next number being 1 is the addition of the two numbers before it, 0, 0. 2 is the addition of the 1 and the 1 that came before it. 3 is the addition of 2 and 1, so on and so forth. And it grows exponentially, which is why the spiral, when laid out visually, also grows exponentially. And what we care most about in trading is the golden ratio, which is 1.618. There are many more decimal places, but you'll always hear it referred to as the 618 or the 1.618. And you get this number by dividing any number in this sequence, no matter how far in you are, dividing any number in this sequence by the number that comes immediately before it. And as you go deeper into the sequence, further along bigger numbers, the ratio tightens towards 1.618. It grows ever closer no matter where you are. So 8 divided by 5 is close to 1.618. 13 divided by 8 is a little bit closer. 21 divided by 13 is a little bit closer. This ratio shows up in nature. It's very common. Anytime you see a spiral, a growth pattern, the petals along flowers, galaxies, and humans, whether we like it or not, we're deeply pattern driven. So when this ratio shows up in different places or things that are man-made, it's very likely it's because we are pattern driven. So it shows up in the market because the market is human made. It shows up in market structure, in pullbacks, in trend legs, in liquidity levels. So that's where we pay attention. And because enough people pay attention and they believe the level is important, it becomes important because a lot of market flow acts on those levels. So indicators, there are a lot of indicators that include Fibonacci. What I will say right now is that very few of them are more necessary than the most basic ones. They are just additional bells and whistles. They look great. You can see things like the Fibonacci spiral, the Fibonacci circle, the Fibonacci pitchfork, all those different tools. They've all got a place. They've all got a use. Everyone can, say how useful they are for their own strategy. But realistically, most of them are just additional color that don't provide too much more information than what you can glean from the standard Fibonacci tools. So starting here, and this is applicable to all indicators, they are tools, not signals. They don't tell you what's going to happen. They show you where things are likely to happen. You think of them as markers, levels that traders watch, levels where liquidity stacks up, and levels where reactions are more likely to occur. And that's it. But the catch is you need to know how to place your Fibonacci levels, or the data just means nothing. So most traders can sort of slap on a fib on any random candle, but then they'll wonder why the levels aren't being respected, or they'll come up with justifications why the levels weren't respected. And the power of the Fibonacci comes from correct placement and correct context. So the process when you're looking at these charts is, number one, first, you have to learn to identify a clean swing high and a swing low. Then second, you observe how price reacts at those levels. And then, does it hesitate? Does it reject? Does it absorb? And then finally, you use that behavior to design setups and refine your edge. So the Fibonacci won't give you the setup and the edge. It won't give you a system, but it will give you structure that you can design your system and your edge around if you already understand what's going on. So we're going to jump over to, this is May 22nd's day on the SPY ticker, the SPY ticker. So we're going to come over here. We're going to use the trend-based fib extension, the most straightforward, simple tool that you can use. And what we're going to do, or before we do that, we're just going to highlight a swing low, a swing high. So you can see that there's our local low, and price came back to test that same local low, and here's a local high. And the way that you use this tool, the way that we place it correctly, is that you actually have to pick the correct zones, which means that you have to pick the low, you have to pick the high. You can put it wherever you want, but if you want it to be useful information, you have to know how to place it. So we're going to pick our trend-based fib extension, and we're going to start at the very low. We're going to bring our second placement to the local high, and then you take it down to the next low. And the way that we're picking these areas is, if the time frame we're on, this is the 5 minute, you start at a low, and then you take it up to a high, which is identified when price stops going in that trend direction. So you can see from this point, broke the trend to go down. We pick the next low point of this same time frame, and you can see that price stopped going down here and started going back up. So that's how we're picking our third point. The levels that you can see laid out are labeled 1.78. This gold area, you can see the 618. This is our golden pocket, the most important level at the moment. That's the halfway mark, not technically a fib, more of a psychological level. This is the 236, and that's our zero. And you can see just with the placement here, the whole rest of the day in this action lined up very effectively with these fib levels. You can see that price bounced very effectively here at the 236. It came and tested the golden pocket once, twice, 3 times before basing in the zone and then breaking above. So it was a resistance in this level. It then broke above, and then it acted as a support. You can see the wicks. You can see it supported in this level before breaking below, and then it acted as resistance again here and here before breaking above. So that's generally what happens with these levels. They flip the polarity, but the golden ratio, you can see break up, break down, break up. This last exit zone down here is institutions rolling out, so we're not going to use that as part of the fibs. But this is just a key placement, and it shows how these levels can be used throughout the day. Even up here, the full, you can see that price rejected after wicking through the 1. You can see over here, it based on the 1 before breaking above and then using it as support. And you can see coming back down here, the zone, it was near the 236 area. However, it did stop on yesterday's close liquidity.
Iron trades.